Hello, this is Mike with NetPicks.com and the Options Mastery Program. In this video, I thought I would take a few minutes to walk through what I'm going to call our trade of the week. It's just an example of how we try to identify trades, some of the criteria that we look for, some of the steps that we follow, and I'll show you one of the areas that I'm looking at here heading into next week. So, one of the things that we want to look at on a daily basis is where is volatility at? Okay, because my first choice when trading options, my first choice is always to sell premium. Okay, but the only time we sell premium is really when volatility is high. We know that if we sell volatility when it's high, our odds of success really start to go up. So one of the areas that I look at, if I click on the Market Watch tab inside of the Thinkorswim platform, I mean, you can track volatility on any type of broker platform that you have access to, but I like to look at it in the Market Watch tab, and you'll see that I have this column here called IV percentile. And I use this to track and gauge how high volatility is for that specific product that I'm looking at. It's not just enough to look at the VIX because that's the volatility in the market as a whole. I want to look at the volatility for an individual name because if we just look at the VIX, I mean, look at this list of symbols that I have up here. I mean, we have some names that have IV percentiles in the 70s and 80s. I have other names that are extremely low in the single digits. Okay, so it's crucial that we have to look at each name on our lists. Now, one of the areas that I've looked at, notice that we do have a number of individual equities here at the top of the list that have high IVs, but I'm not going to consider those because the volatilities are pumped up because of the earnings releases that are coming up. Okay, the market makers are pricing in the unknown with those earnings numbers. So I don't want to mess with those names. So my focus shifts to some of these individual ETFs down here. Any symbol that does not have a red phone listed next to the symbol, I can consider because those red phones there, those mean that they do have earnings coming up. So if I look at some of these other names, I've got IBB, which is the biotech ETF. It's got a decent volatility. I've got OIH. It's an oil name, one of the oil ETFs. That's another area that has some decent volatility. So I'm going to focus on these names that are elevated. I want to see that they're at least close to that 50 number. Ideally, I'd like them to be over 50, but the market, the volatility is pretty low market wide right now. So we've got to be a little creative. So I look at OIH and I see that okay, we're pretty close to that 50 number. So that has me looking at a potential trade. Next thing I do is I go over to the chart. Now, I don't have any indicators on the chart. It's not necessary here. All I'm looking for on this chart is I need to form an opinion on what I think the market's going to do. Am I bullish? Am I bearish? Am I neutral? Because that influences what type of option strategy that I'm going to look at. Okay, so when I look at this chart on OIH, we've seen it get pretty beat up along with a lot of other energy names earlier in the year. Okay, and now we've kind of settled into a little bit of a range. We've kind of bounced back and forth, but now we're kind of settling in around that 30, 31 area. Okay, so I look at this chart and I say, okay, for me personally on energy, I'm neutral to slightly bearish. So I want to put on a strategy that reflects that. So let's go to the trade page next and see what we can do. So I'm going to click on the trade page here, and now I look at, what type of expiration cycles do I have access to? I do have some weekly options. In my experience, what I have noticed is that most weekly options do not have very good liquidity. There's just not a lot of activity in them. So I'm going to go out to the November options. There's 34 days left to expiration. So I'm going to pop that up. So now I need to decide, okay, if I'm neutral to slightly bearish, could I sell a call spread? Well, that's one thing I could do. If I sold a call spread, it is more of a bearish position. I do have a little bit of wiggle room potentially on the upside, but it's more of a bearish position. I don't want to be totally bearish here. I want to have a little bit of a neutral twist to the trade. So I'm going to consider an iron condor. Now, don't be intimidated by the name. Okay, it's a trade that can be put on to create a profit window. So instead of picking direction, we're trying to pick a range that stock needs to stay inside of. As long as it closes inside of that range, we can make money. I don't care if it goes higher, lower, or sideways, we can make money. So what does that look like? The iron condor, by definition, if we're going to sell an iron condor, we're going to sell an out of the money call spread and an out of the money put spread at the same time. And we're going to try to keep the price of the stock right in the middle of our short strike. So let's take a look here. I'm just going to go into the November options. I'm going to right click on this November 32 call. I'm going to go down to sell, and I'm going to select Iron Condor. Okay, so by default it's going to pull up an Iron Condor. There's 4 different options as part of this trade. We have the call spread and the put spread, and it really doesn't matter which strike price you click on to set this trade up, because we can always, once it's popped up here down at the in the order entry box, we can always adjust the strikes and tweak it to what we want it to be. So I want to sell an out of the money call spread, so I'm going to look at selling the 32-33 call spread. That's selling the 32 call and buying the 33 call to make it hedged. I don't like to sell naked options. I like the defined risk aspect of an Iron Condor. Now on the put side, I'm going to adjust these strikes. I don't want to sell the 31-30 put spread. I want to sell junky out of the money options. So let's go ahead and adjust these strikes here. Let's go ahead and adjust these down to 29 and 28. So now I'm selling the 29 put and I'm buying the 28 put to make it hedged. So now what I'm doing essentially is I'm going out and I'm selling it out of the money call spread, and I'm selling it out of the money put spread, and trying to keep the price of OIH roughly centered. Okay, I want to keep it in the center of our short strikes. We sold the 32 call and the 29 put. I want the current price somewhere close to the middle of those 2 strike prices. Okay, now I collect 54 cents for putting on this trade. We're collecting a credit to put the trade on. So that 54 cents is the most we can make on the trade. Okay, so now if I click confirm and send, you're going to notice here we have 2 break-even points. We've got a call spread and a put spread here. The break-even points are calculated by taking our short strikes. So we're going to take our 32 call. We're going to add on 54 cents. That's what we're collecting to put the trade on. That becomes our break-even point on the upside, 32.54. On the downside, we're going to take our short put strike, which is that 29 strike put. We're going to subtract 54 cents from that, and that's going to put our break-even point on the downside at 28.46. So now what we have here is we have a trade that we don't care if it goes slightly higher from here, as long as it closes below 32.54. I don't care if it goes slightly lower, as long as it closes above 28.46. I don't care if it goes straight sideways. We can potentially make money in all 3 different market directions. That's pretty powerful, right? I mean, that now all of a sudden we're taking direction out of the equation. We don't have to be 100% bullish, 100% bearish. We don't care. Now, let's sweeten the pot a little bit more. Since we're collecting premium here, we're collecting a credit. Instead of putting on a position where the time decay works against us, anytime you buy a call or you buy a put or you buy a vertical spread, the moment you put that trade on, it's losing value from time decay, which means that move has to happen in your favor fast enough for you to make money. We're flipping that all around here, because now we're putting time decay in our favor. The longer we hold this trade, the more money we can potentially make from time passing. Okay, we're becoming that insurance company, for example. When that insurance company issues your auto policy, what they're banking on is that you go the entire month without making a claim, without getting in a car accident, right? Okay, as long as that happens, they get to keep all your premium. So every day that passes that you don't make a claim on the policy, then they make money. Okay, we're becoming the insurance policy. We're collecting money up front, and we're hoping that that stock does not move outside of our break-even points. We're hoping that this stock doesn't get in a car accident and has to make a claim on the insurance policy. If that happens, we get to keep the money. Okay, that's pretty powerful. We also make money from volatility contracting. When we collect a credit, ideally what we want to do to close this trade out, we want to buy this trade back cheaper. We want these options prices to get cheaper. Well, we talked about volatility right off the top. We mentioned that we want to trade names that ideally have volatilities that are relatively high compared to, normal conditions. Because if volatility is high, what does that mean? Over time, the volatility is going to want to contract. It's going to want to go back lower. So if volatility contracts, that means the option prices are going to get cheaper, because volatility is a big component of the pricing model. So if volatility contracts, we make money. So now we make money in potentially all 3 market movements. We make money from time decay, and we make money from volatility contracting. That's 5 different ways that we can make money. That's why I love these trades, because we don't have to be perfect. We don't have to pick market direction and hope that the move happens fast enough. Now we take it out of the equation. We're giving ourselves multiple ways of being profitable. That 54 cents is the most that we can make on the trade, the $54 per spread. Okay, it doesn't seem like a lot of money, right? But look at what it's taken to put this trade on. Okay, our requirement here, our maximum risk is $46. It's the difference between the strikes. There's a dollar-wide difference between these strike prices minus the credit that we received. We collected 54 cents. So our maximum risk is $46 per spread. You could put this trade on 10 times and still have less than $500 at risk. Okay, not too shabby, right? Now let's take it over to the chart here. What I've done is I've drawn some horizontal lines at our break-even points, so you can kind of get a visual here. Okay, so we've got our break-even points with these red lines. I don't care if it moves higher, lower, sideways, or a combination of all three of those over the next 30 days. As long as it stays inside of our profit window, we make money. Now, what happens if we're dead wrong? What if we pop outside of our profit window? Well, worst case scenario, we're out $46 per spread. Okay, that's why I love this trade. Now, keep in mind too, for those of you that have traded iron condors before, you know that you know how they react. If we put this trade on now, first of the week, next week, the trade is not going to really react very quickly to P&L in the near term. These trades really don't start to react until the last 2 weeks before expiration, which means for the next 20 days, for the next 15 days, we don't really have to do much with this trade. It's not going to do much. So that way we can put the trade on, let it work. We can get on with our work schedule, our family schedule, and not have to worry about staring at the screen all day long. I love putting these trades on. Okay, just put some money to work. I have 5 different ways to be profitable, and this is a neutral to slightly bearish trade. Now, we'll talk in further videos down the road. We'll talk about ways that we could potentially put a directional twist on these trades. There's literally a dozen different ways that we can trade iron condors. So they're really fun trades, really flexible trades that we can use. So I like this trade heading into next week. I'll track it here. I'll jot it down, and we'll track it in the videos upcoming to see what happens. Were we right? Were we wrong? And what is the outcome of the trade? So again, we're selling the 32-33 call spread. We're selling the 29-28 put spread at the same time out in the November monthly options, and that creates our iron condor. It's essentially a trade. It's creating a profit window, trying to box the price in, and that way we just give ourselves multiple ways of being profitable. So love this trade. This is the process that I go through every day to try to identify these positions, and I just walked through it in great detail. It took about 12 minutes to do so. When you're looking for these trades and you're not explaining it, I mean, you can literally find trades in a couple of minutes. So you don't have to sit there and spend all day long in front of the computer. You can get a lot of trades on very quickly. So these are the types of positions that we look for all the time in the Options Mastery program. So take advantage. We'll track it. If you have any questions, as always, feel free to reach out, mike@netpicks.com. So I'll wrap this video up here, and we'll talk again next week.